Is Morgan Stanley right? Are we about to see a major stock market correction? Is economy flatlining? And is inflation about to be rejected? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. None other than the Chief Equity Strategist of Morgan Stanley is calling for a major correction in the equity market. And I know it seems hard to believe as stock prices, for some reason, continue to grind higher as investors continue to bet on this bull market going even longer and higher. Let's take a look at what the Chief Equity Strategist said for Morgan Stanley. And we're going to go to this article on Zero Hedge. This Morgan Stanley warns crashing breadth will result in material correction. Well, we'll explain what breadth is here in a moment, but let's just look at a little bit of this article before we explain that. The article says market breadth has recently gone from bad to abysmal, with the number of S&P stocks above their 50-day moving average at just about 50%. Now let's stop for a second, and for those of you who don't know what the 50-day moving average is, let's bring you up to speed. Now if you take the average price over the prior 50 days of the closing price, you get what's called a moving average. And when the stock price closes above the 50-day moving average, it's considered bullish. When it closes below the 50-day moving average, it's considered bearish. So what this article is looking at is the percentage of the S&P 500, which is 500 stocks, that is above, and the percentage that is below, and trying to determine if this is signaling that a crash is imminent. Let's continue on. And it says, again, with the number of S&P 500 stocks above their 50-day moving average at just about 50%. So it's indicating that approximately 250 stocks are above and 250 stocks are below, with a very tiny increase from the 47% on June 29th when the S&P hit its first of many consecutive all-time highs. Now let's take a look at that chart, and here you can see unusually narrow breadth. The lowest percentage of stocks above their 50-day moving average since 1999 when the S&P hit record. So what this is saying is there is a problem in the breadth of the market because there are too many, the lowest percentage of stocks above their 50-day moving average. There's very few. And here you can see, and I'll show you how this looks against the stock market in a moment, but let's just understand this graph. You can see it's saying just around 50%, and the last time that happened was well in the late 1990s ahead of the dot-com bubble. Let's continue on with this article because it only gets more interesting. So let's come down here, and it said a recent note from the company's increasingly doom and gloomish chief equity strategist, Michael Wilson, who recently reemerged as Wall Street's biggest bear. Well, clearly he's never met the bear lord, and reminded clients his core view for 2021 is that earnings would surprise the upside, but valuations would come down. Let's continue down here because he talks about market breadth. Well, Wilson adds, in addition to all of the other market signals that support his mid-cycle transition narrative, the overall market breadth has deteriorated significantly. He notes that this is also consistent with a mid-cycle transition and usually precedes a material, keyword material, index level correction that marks the end of it. So what he's saying here is stock prices have to go down and are going to happen relatively soon. How bad is the breadth? Well, according to the Morgan Stanley strategist, over the last month, it's the weakest we have ever witnessed, with the S&P making new all-time highs. So what he's telling you here is the breadth and the percentage of stocks above the 50-day moving average is declining, and oddly enough, stock prices are continuing to rise. Well, we're going to dive into exactly why that is happening and then what the outcome is, and if he's right. More specifically, he said there are more stocks making 52-week lows than highs when looking at the broad universe of stocks in the market. So if we go over to this, we'll zoom into that image here, and he's saying, look, you have stocks making 52-week lows. That is not something you expect to see when the market is making new all-time highs. And in fact, when that tends to happen, you enter a bear market or you have a correction. Let's continue on with his piece here. He says, further, the percentage of stocks trading above their 50-day moving average is below 50% for the S&P 500, and it's much worse for the lower quality indices. So you can see what he thinks of other major indices. And let's take a look at that picture here, and we see percentage of stocks greater than the 50-day moving average is falling quickly. Now this is very interesting because you can see in the past, as this falls, it tends to lead the stock market down. And here you can see the percentage of stocks above the 50-day moving average was headed lower, so fewer stocks were above, and the market continued to go higher, and then it came down. And you can see this here. It started coming down, and the market came down. The same happened here, and we see this event over and over again, that the percentage of stocks greater than their 50-day moving average starts to decline, and it often precedes a bigger move down in the market. So you see that here in 2020, March 2020, and then again in late 2018. So what he's suggesting to you is that we are in a mid-cycle, perhaps of a bull phase, and stock prices need to come down. Does he stop there? Well, let's go take a look real quick and see. And he says at the same time, he talks about the equal weighted S&P. Now, why does this happen in a market cap weighted indice? So the way market cap weighted indices work is when you put $1 into the S&P 500, it's not equally split across all 500 companies. More money goes to the biggest companies in the index. And that's very important because when we zoom in and we'll take a look at SPY, which is the largest ETF that matches the S&P 500, you can see that over 20% of the index goes into Alphabet, which is pretty much Google, Facebook, Amazon, Microsoft, and Apple. So for every dollar, more than 20 cents is going in to these four companies. And what he's indicating is as the smaller companies in the index fall below their 50-day moving average, as they hit new 52-week lows, it's going to act as a weight or an anchor and pull the rest of the index down. Now, if you'd like to have your own chart, and maybe you don't want to look up that article, but you want to have your own chart, here's a way you can do that. You can go to indexindicators.com. This is totally free, and you can find the percentage of S&P 500 stocks above their 50-day moving average. And you can see that this is updated every day, and it's somewhere, looks like right near the 50%, a little bit below that. And as this goes down, again, the Morgan Stanley strategist said that the stock market's going to come down, and you can see as it comes down. Here's a little clearer picture. Stocks go down. We can see it heading down. Stocks go down here. It starts to come down. Stocks go down. And you can see this event happening over and over again. So he's saying this is a big warning sign, but when it gets to 3 standard deviations or pretty near that, well, that's an indication that perhaps it may be a time to buy. So the question is he probably right or is he probably wrong? Well, based on the percentage of stocks making new 52-week lows and the market breadth, the odds are he's right. We're probably going to see a correction because what's driving the market higher is a small number of very large companies, and eventually they will follow the smaller companies down. Let's take a look at the economic data because there's quite a bit of interesting things going on here. And we're going to start out with the Chicago Fed National Activity Index for June because the question is the economy flatlining? And well, based on the CFNAI, it starts to look like it is, and it printed at 0.09, and if you recall, a print of 0 means it is growing at the trend rate of growth. So a 0.09 means it's effectively growing at the trend rate. But normally, if you zoom into this, it actually tends to, in a bull market or a expanding economy, grow above 0 more consistently than at 0. So let's zoom into the Chicago Fed website. And here we can see coming out of the pandemic, the Chicago Fed National Activity Index shot up, and then it's kind of been flatlined, dipped, got a little more stimulus, popped up, and it's just going nowhere. It actually briefly dipped negative, and here it is at 0.09. And if you look at production income, it's at 0.01. Personal consumption, which you want to drive the economy, minus 0.08. So it's saying nothing's really happening here. How about employment, unemployment, and hours worked? 0.09. Sales, orders, and inventories, which everyone's super excited about because they think that American consumers are going to go out and buy even more stuff. That's at 0.06. So what it's telling you is the national economy is stagnating. It's growing at trend growth, but that's not what you want when you have stock prices heading higher. How about inflation? Well, you have to have, this is really interesting, the 3-month moving average of the CFNAI above plus 0.7. Remember, we're at 0.09 for more than 2 years into an economic expansion to get inflation. I guarantee you the Fed looks at this because it's from the Chicago Fed, and this is telling you the odds of inflation from this data series is extremely low. So the notion that we're going to continue to see rising inflation, the Chicago Fed National Activity Index says not going to happen. You need 2 years above 0.7, and we're not even remotely close. We're at 0. So no sign of that. Now, how about unemployment? Let's take a look at the statistics here, because this doesn't look much better. In fact, initial jobless claims, we'll go to the Department of Labor, went from 368. Remember, it was starting to trend down. We got under 400, and we were starting to head lower, which is a good sign. But 200, around 200 is the right number of claims in a healthy economy where there's strong labor demand. And lo and behold, we're back over 200 on a seasonally adjusted basis at 419,000 new initial claims for unemployment benefits. Let's go down here and look at the pandemic claims. Notice they dropped 1.26 million. So clearly now we're starting to see in the data all of the states who are dropping off their pandemic unemployment assistance. And after September 6th, when they all end, well, we're going to see a lot of these numbers should start to go to 0 very quickly after that. Now, a fan of the show pointed out, he said, Steve, be sure to check out page 11 and check this out. States with an increase of more than 1,000 initial claims. Texas reporting layoffs in the manufacturing industry. Now, is that due to COVID increases there? I mean, because all we're hearing is there's shortages. Why would they be laid off in the manufacturing sector? Doesn't that seem strange? Seems strange to me. I don't have an answer for that. Looking at New York, layoffs in transportation, warehousing, construction, public administration. Why is warehousing and construction and transportation seeing layoffs? That really doesn't make any sense. How about Tennessee? Retail trade? It doesn't make a whole lot of sense why we're seeing these layoffs if we're supposed to be in a new secular phase of growth. Now, I want to add to this, for a lot of people who believe that, we are in a secular or the beginning of a secular rise in inflation, I want you to understand the Fed's perspective here on unemployment, because according to the Fed models, this is important to understand, their models say that you must have full employment to get sustainable inflation. Because if everyone's at work and everyone's consuming and making wages, well, that means demand has the potential to exceed supply. One of the reasons they are thinking this is transitory is real simple, because when people are on unemployment benefits, they generally make less than they did when they were at work. Now, due to the government benefits, we've seen those numbers go up in terms of wages because of the extended unemployment benefits. But as those go away, I want you to ask yourself, how are consumers going to be able to afford higher prices? Will they be able to? Well, I'm going to show you something toward the end here that may help you with that. Let's continue on, and here you can see initial claims. They're starting to bottom and maybe turn up. Now remember, 400,000, just to put this in context, this is what you would normally see in a recession. Not when you see stocks at all-time highs, not when everyone's bullish on equities. This is when the bad news is bad and getting worse. So this is troublesome. Let's take a look at the Kansas City Fed survey. Let's move on to their manufacturing index. This is a little bit wrong, 30 to 41. It did increase, but not quite that much. We can go up here and see it increased from somewhere. Where is it? Here, the month-over-month composite index was 30 in July. Oh wait, maybe it was up from 27. I thought it was a little. Oh yeah, 27. The other thing was reporting a little smaller. So what that means is the manufacturing sector in Kansas City increased. But I want to show you these special questions, because this is interesting. When you look at the unemployment data, this doesn't make sense. In July, 91% of firms reported workers were in short supply, more than any time previously asked in survey history. Wage pressure. So that doesn't make sense. Why are we seeing layoffs? Maybe these people need to go to Kansas. Wage pressures also surpassed survey record as 78% of firms reported having to raise wages. Attract new talent. 72% of firms reported raising compensation. 60% reported hiring less than qualified. So look, if you don't have a job and you're not qualified to work in the manufacturing sector, great, go to Kansas. They've got apparently jobs for you. They even have increased overtime, automation. That's not good for new hires. And 30% reported upskilling or reskilling or retraining some of their workers. So it's kind of interesting that here in Kansas, there seems to be a major labor shortage, but you wouldn't know it based on the initial claims. How about the Treasury auction this week? We had a TIPS auction, and one thing that was really interesting is we had a high yield of minus. That's right, minus 1.016%. Now, if you're wondering, that's negative yield. That is indeed a negative yield. A lot of people say you can't have that. Well, there it is. You see a negative yield on TIPS. Now, what does that mean? Well, it means people who bought at this auction are going to see a negative yield. They're going to lose money on that. You might be asking, why would they do that? Very simple. Because they believe that inflation is going to continue to rise. And since these are their TIPS, Treasury inflation protected securities, they believe the value of the bonds are going to increase faster than the negative 1% they're paying per year in interest. So that's what they think. Will they be right? Well, I'm not sure they will. Let's go back to the economic calendar and see. We've got some preliminary, all these, they say preliminary manufacturing PMI coming out of Australia shows the manufacturing sector slowed just slightly over the prior month. The services sector, due to the lockdowns, went into a contraction, and that isn't good. Potential sign for the rest of the world's economy as perhaps the Delta variant and maybe even other variants start to show up. Moving over to Great Britain, we've got retail sales month over month of 0.5%. That's a nice number coming off their minus 1.3. Core, which excludes food and energy, up 0.3. Let's take a look at these other manufacturing PMIs. Again, remember, they're all preliminary. They're not the final numbers for July. They're just estimates. How about France, manufacturing PMI down just slightly, so just slightly slower growth than the month before. France services PMI pretty much right, almost the same number, just a touch slightly slower growth, but overall pretty good numbers there at 57. Going over to Germany now, manufacturing PMI just slightly faster at 65.6 over the prior month, so a nice number. That's a pretty strong number. Services sector also expanded at a faster rate at 62.2. The broad Eurozone manufacturing PMI just slightly lower, but at 62.6, showing that the manufacturing sector is growing at a decent clip. Those are otherwise good numbers. Services sector in the broad Eurozone growing slightly faster at 60.4. Heading back up to Great Britain, we've got the manufacturing PMI just slightly slower at 60.4, but 60 is a great number. I mean, when you get these numbers, 60, 62, 65, they're still showing there's strong growth there. Services PMI slid down to 57.8, still a decent number there for Great Britain. How about the U.S.? We got the market manufacturing PMI. Preliminary data showing the U.S. manufacturing sector is increasing at a slightly faster rate than June. And the services sector, this surprised the market, but it didn't seem to care. The services sector slowed 64.6 and is a preliminary number 59.8, showing the services sector, which to me is a bit odd. The services sector should be increasing here because normally you start to see peaks in the manufacturing PMI, but the services sector lags it. And I mean, it makes sense that it lags because, as manufacturing starts to slow down, there's still other money flowing from the manufacturing sector out into the services sector, so it tends to lag. A bit of a concern that we're seeing a slowdown in the service sector. Now, the question then is inflation going to get rejected? Check this out. We've got the Atlanta Fed wage growth tracker coming in for June at 3.2% overall unweighted, showing that hourly wages are growing at 3.2% over last year. And that doesn't include one-time bonuses or things like that. So now the question is, if your wages are growing at 3.2% a year, can you afford higher prices? Well, according to the Consumer Price Index, no. Consumer Price Index growing at 5.3% over last year, which is an indication, and something that I've shared with you, of why higher prices will get rejected, because consumers can't afford them. They will have to make decisions on where their money goes, on what they spend it on, because something is going to be lost. I mean, they're obviously going to spend it on food, and housing and utilities. There's key things they're going to spend it on. It's those discretionary goods and services that are the ones that go when you don't have enough money to afford those higher prices. So for a lot of people saying that inflation's only going to go higher, well, you've got to have wages keep up with it. Otherwise, you can't sell goods and services to people who don't have the money to buy them. And when that happens, higher prices tend to get rejected. So it's giving you an early indicator that these price increases are indeed transitory. We'll take a look at the banking data on Monday, but we'll wrap up the show. For those of you who stayed for the Sunday night chart show, we'll see you on Sunday. A lot of indication of topping patterns in the market. Otherwise, we will be back on Monday for the Macro Show. I'm your host, Steve Van Metre. Thanks for being fans. Thanks for watching, and I will see you soon. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This show is not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in a particular trading strategy. This video is prepared by Steven Van Metre. Personal capacity opinions expressed in this video do not reflect the Atlas Financial Advising or Steven Van Metre Financial.